Have you ever noticed that fuel prices seem to rise before everything else? Before groceries, before rent, before your wages ever move? And it leaves you wondering, why does it always start with fuel? Why does it always feel like the cost of living rises faster than your income and no one seems to explain it plainly? What you usually hear are scattered explanations of corporate greed, supply chain disruptions, bad harvests, or interest rate changes. And to be fair, these do affect prices. A drought can raise food costs, and interest rate changes make the cost of borrowing more expensive. They are real triggers, but they are often surface-level causes rather than the full picture. Widespread inflation rarely comes from a single event. It happens when those visible shocks hit a system already stretched by energy dependence, debt expansion, and monetary policy. The headlines explain what moved prices today, but not why everything seems to move together or why wages lag behind. So, people are given fragments instead of the chain. Today, we're going to break that chain down in simple terms, not political talking points or academic jargon, just the mechanics of how money, energy, and prices interact, and why the feeling many people have that the system is stacked against them isn't irrational, but rooted in real economic structures. The first domino is energy. Energy is not just fuel for cars. Energy is fuel for everything. Every truck delivering food runs on diesel. Every factory needs electricity. Farmers need fuel and fertilizer. Shipping companies burn enormous amounts of oil. Even the internet runs on power grids. So, when energy prices rise, it is like increasing the cost of oxygen for the economy. Every product and service depends on it. Historically, you can see this clearly. In the 1970s, oil shocks, energy prices surged, and inflation followed. In 2008, oil spiked above $140 a barrel, and the cost of living surged globally. More recently, during supply chain disruptions and monetary expansion, fuel and electricity prices were among the first things households noticed. Energy moves first because it is upstream of everything else. The second domino in the chain is commodities and capital goods, the raw materials and machinery that make everything else possible. Capital goods are the tools businesses use to produce things. Machines, construction equipment, factory robots, commercial vehicles, computers. These are not items households buy daily, but they determine what households will pay later. If steel and electricity become expensive, then machinery becomes expensive. If machinery becomes expensive, production becomes expensive. If production becomes expensive, consumer goods become expensive. It is a ripple effect. Think of it like cooking. Ingredients rise first, then kitchen equipment, then the price of the meal. And only later does the chef's salary adjust. Then, almost instantly, financial markets jump ahead, pricing in the future before the present has even caught up, anticipating what will later unfold in the real economy. Stocks, property, bonds, gold. These often rise before consumer prices because investors are forward-looking. They anticipate currency dilution and adjust early. This is why you often see house prices and stock markets rising while wages stagnate. It is not because people suddenly became more productive overnight. It is often because excess money supply flows first into assets before it flows into wages. Historically, this pattern appears again and again. After large monetary stimulus periods, asset inflation often precedes consumer inflation. People who already own assets benefit. People who rely purely on wages fall behind. And this is one of the core structural frustrations many feel, and it is not imagined. Consumer prices are where the shift becomes personal, the moment people actually feel it in everyday life. For most households, inflation is not commodities or financial assets. Inflation is the supermarket, the rent letter, the energy bill. This is when purchasing power loss becomes visible in daily life. But economically, the process started earlier in commodity markets, in capital goods, and in asset markets. So when groceries rise, It is not the beginning of inflation, it is the confirmation. And finally, wages adjust last, often lagging behind everything else. Contracts, negotiations, employer resistance, and productivity debates slow wage increases down. This is why many people feel like they are running on a treadmill that speeds up while they stand still. Prices move quickly, wages move slowly, the gap widens. And this is not necessarily a personal failure, it is often a structural lag built into how modern economies operate. We know purchasing power has fallen when our money no longer stretches as far as it used to. A currency doesn't come with a gauge saying down 5% today. Purchasing power is a relationship. It is how much your money can buy relative to goods and services. Prices are the signals. Energy prices, commodity prices, asset prices, exchange rates, consumer goods, all are thermometers of currency value. You don't see purchasing power fall directly. You infer it through rising prices. Beyond local markets lies the global currency layer, how international trade, and energy trade in particular, influences domestic prices. Many countries sell oil and commodities in dollars. This creates constant demand for that currency even if its domestic purchasing power weakens. So you can have a strange situation where your dollars lose buying power at home but remain strong internationally. These are two different measurements: domestic purchasing power versus global exchange demand. This complexity is why people often feel confused when headlines say a currency is strong, yet their cost of living rises. Both can be true at the same time. So why does this matter to real people? Because this is where theory ends and life begins. When prices rise faster than wages, people feel squeezed. They feel like they are working harder but moving backward. They feel like the game changes mid-play. And often, public narratives tell them it is their fault, that they didn't budget correctly, didn't invest correctly, didn't work hard enough. But when you look at the structural chain reaction of monetary policy, energy markets, asset inflation, and wage lag, it becomes clear. Many pressures are systemic, not personal. If housing inflates faster than wages for a decade, that is not an individual moral failure. If asset holders benefit from monetary expansion while wage earners struggle, that is not laziness. That is policy distribution. Because beyond the mechanics and the numbers lies a moral dimension that cannot be ignored. When policies consistently reward leverage and asset ownership while penalizing labor and savings, people feel injustice. That feeling is not irrational. It reflects the distribution effects of policy decisions. Throughout history, periods of heavy monetary expansion have often widened wealth gaps before social pressure forces recalibration. From the late Roman currency debasements to modern financial cycles, the moral tension repeats: who benefits first and who absorbs the cost later? When ordinary people struggle under rising costs, it is not simply because they failed. Often, it is because structural incentives moved capital upward faster than income could follow. Put together, the chain reaction becomes clear when viewed as one continuous flow. Energy and raw commodities rise first. Capital goods and production tools follow. Financial assets often jump ahead on expectation. Consumer goods rise later. Wages adjust last. Purchasing power loss is observed through prices, but the forces driving it start much earlier in the system. And as a closing thought, it's worth reflecting on how understanding the chain changes how we see our own situation. It doesn't instantly remove economic pressure, but it does something powerful. It lifts unnecessary self-blame and replaces confusion with awareness. When you feel like the cost of living is rising faster than your income, you are not imagining it. There are structural mechanisms behind that experience. Education does not eliminate hardship, but it transforms helplessness into comprehension. And comprehension is the first step toward making better decisions, individually and collectively. The system is complex. But once you see the chain reaction clearly, the fog lifts. And when the fog lifts, you stop thinking, oh, Pet, what's wrong with me? And start asking, what forces are actually at work here?